Good afternoon, and welcome to the opening session of Energy Finance 2020 online. I'm Sandy Buchanan, Executive Director of the Institute for Energy Economics and Financial Analysis. We'd like to thank everybody who made it possible for holding this online conference over the next 3 weeks, especially our speakers and moderators who are sharing their expertise and perspectives with us, our talented production crew, and our very generous funders. Our opening session today is on financial experts' predictions for the U.S. electricity mix. Our moderator is Liz Stanton. Liz is the founder and clinic director and senior economist at the Applied Economics Clinic in Boston. Prior to founding the clinic in 2017, she was an economist at Synapse Energy Economics and at the Stockholm Environmental Institute's Applied Economics Group. And now let me turn this over to Liz to get us started.
Thank you, Sandy, and I'm so delighted to be here and be part of this first ever remote IEFA Energy Conference. I'm going to start out by introducing both speakers and then tell you a little bit about how to ask questions as we go along. So, Jim, thanks for being with us. Jim Hempstead is the Managing Director at Moody's Global Project and Infrastructure Finance Group, where he helps to manage the North American Regulated Utility and Power Team and the North American Public Infrastructure Team. Jim acts as a rating chair across all segments of the Global Infrastructure and Project Finance franchise, and he also manages the rating agency's Cyber Risk Team, which looks to incorporate cybersecurity risk into credit analysis globally. In prior years, Jim helped manage the firm's environmental, social, and governance efforts between 2017 and 2020. Jim joined Moody's in December 2002, having previously spent time as an investment banker with Merrill Lynch and Smith Barney. From 2011 to 2013, Jim served as the Director of Emergency Management for his hometown in New Jersey and as a registered EMT for his local volunteer first aid squad. At present, he's been spending his COVID-19 time in Massachusetts, where he's learning how to fish. Thanks, Jim. Julian, I'll introduce you next. Julian Damone Smith is a managing director in the Americas Equity Research at Bank of America Merrill Lynch, covering U.S. power, utilities, and alternative energy, based in New York. Previously, he was an executive director at UBS in a similar role. Julian was ranked number 2 in the Institutional Investor All-America Research Poll for 2018 and 2017, and number 1 in 2016. He's been ranked number 1 in alternative energy in the Institutional Investor All-America Research Poll for 2018, 2017, and 2016. And he was previously named up-and-comer on the same list and received the top designation for 2012 to 2015 among hedge fund managers on its II Alpha list, a recut version for the II poll for utilities. Julian has a BS in applied math and an MBA, both from Columbia. So my thanks to both speakers. We're going to go on from here and hear a presentation from each one of them. Now, if you have any questions, either for me or for the speakers, we'd love to hear them. And on the right-hand side of the live feed, there's a chat box with 3 tabs. The first tab is a live discussion, where you can share your opinions and reactions to the session with the other audience members. On the second tab, you'll find the live Q&A. Use this to ask a question that you want to the speakers to answer. And if someone else has asked a question that you like, click the thumbs up and the question will be pushed to the top of the list. So I'll be keeping an eye on all of your questions, and after both speakers get their chance to talk, I'll be passing them along to them and getting answers for you. Thanks so much, everyone, for joining us, and let's start it off with Jim's presentation.
My name is Jim Hempstead, and I'm a managing director in the Project and Infrastructure Finance team. At Moody's, our purpose is to bring clarity, knowledge, and fairness to an interconnected world. And in order to do that, we must remain true to our values, which means standing unequivocally against racism and inequality. Our challenge is, of course, now to put these words into actions. And so I'm starting by practicing my words with the start of these types of presentations now. I've been doing this for a couple of months, so thank you for that. We think that a zero carbon power grid is achievable, but execution challenges and cost uncertainties can hamper investment plans. Regulators and policymakers can certainly influence the pace of the transition by combining incentive-based cost recovery mechanisms with a collaborative environmental policy. But we don't think that regulators or policymakers can stop the transition because it's well underway and the economics speak for themselves. Now, the power sector knows what the end goal is, and that's a zero carbon power grid by 2050. The question is whether zero carbon is zero or zero carbon is net. And we do observe that over 48 utilities have announced voluntary emission reduction plans and targets, and over 20 of them have net zero targets, with some of the utilities in Michigan being the latest to jump on the bandwagon. Either way, we see this is where the sector is heading, and we believe it could happen more quickly than people think and be less expensive than the experts are predicting. Now, on the next slide here with volumes, let me just start by highlighting that the utility sector is very different from other sectors like the non-financial corporate sector. The utility sector can disrupt itself profitably, and that's because utilities don't earn a margin on revenue the way corporates do. They earn a return on their capital investments. And utilities have very good access to capital and a very attractive cost of capital. Certainly for the best run utilities, they have a very attractive cost of capital in today's environment. And in fact, our default studies show, and continue to show, that critical infrastructure assets, which includes utilities, default at a 4 times lower rate than non-financial corporates. Now, with respect to volumes, the uncertainty around where volumes are going is higher today than it's been recently. What we see happening with volumes is flat to slightly negative increases going forward. Certainly, the coronavirus will create a big dip over the near term, but we also notice with respect to load duration, the peakiness of some of the power demand is falling, and that's thanks to storage, battery storage, and efficiency. The power grid is old. Capacity supplies are shifting to more environmentally friendly sources and carbon-friendly sources. Some of these sources are farther away from the loads, but we also see more distributed generation being deployed across the landscape. And generation supplies are getting cheaper thanks to technology developments and, of course, low fuel costs with natural gas. The nice thing about the sector is retiring old fossil generating assets and replacing them with new renewable assets is a triple win for the sector, and this has been in place for a couple of years now. Shareholders are very happy with the rate-based growth. Environmentalists appear to be very happy with the reduction of carbon dioxide emissions and other greenhouse gases, and regulators appear to be very happy because there's very little impact on revenue requirements. Now, the reason why I'm showing an average life chart here is because the replacement of the generation is going to necessitate a new approach towards depreciation, and that's going to have to be done collaboratively between the sector and the regulators. We're talking about modernization, not just decarbonization. But recall, we do have 2 monopolies. The physical monopoly, which is the generation assets, the poles and the wires, and the legal monopoly, which is the legislative underpinnings that allows the regulatory oversight and framework to work. Both of these monopolies need to work together in order to drive investment behavior. And what we think is going to happen is that what prevents utilities from taking a very large reductions in impairments and things of that nature related to some of their uneconomic generation is the fact that they have the regulatory supportiveness that supports them. So on the next slide here, I also like to talk about demand. Demand is also shifting in profound ways. Customers are increasingly asking for carbon-free or renewable power. Customers are also leveraging big data to take a more direct management of their energy supply needs. And utility companies are scrambling to meet their customer needs because they don't want to lose those customers. Now, as utilities face more uncertainty around volumes, the shift in decarbonizing the generation supply, and the new demands that big data is bringing to their customers in terms of managing their customer needs, there has been a significant amount of cash recycling throughout the financial statements for the utilities. And what we see happening is that for every $1 of capital investments, It's typically associated with about 15 cents of revenue. And that's primarily comprised of the pre-tax weighted average cost of capital. And let's just call that 10 cents out of the 15 cents. The remaining 5 cents, of course, is depreciation, if you assume straight line, property taxes, and other things. So the cycle that is underway right now in the sector, and it appears to have pretty long runway still, is that if you could reduce operating and maintenance costs, $1 of savings opens up $7 of capital investment without materially impacting the revenue line. $1 divided by 15 cents. And it's important because that $7 of capital that goes into the investment bucket is also going into things that make the utilities more efficient, which reduces O&M and then creates that cycle going forward. Now I'm showing this chart here because utilities have been using a lot of debt to finance their capital investments, and their cash flows have also been affected in part by some of the tax reform and other matters that are going on right now. And so as we think about the math and the running room of this investment cycle, we also want to note that utilities are becoming more levered and that their cost of capital could go up in different market environments. We have developed a carbon transition assessment framework. We published our proposed framework last year. We left it open for market feedback for, I think, 60 days, and we have now a generic framework. And the carbon transition framework is not meant to be a driver of credit ratings. It's meant to be an indicator of risk, which needs to be incorporated into the credit rating. And the way we're approaching this evaluation is to do it consistently across the sectors geographically, so that when we talk about carbon transition risk for a company that's located in North America, we're also talking about carbon transition risk within the same framework for a company that's located in Europe or in Asia or in Latin America. What we've done is we've tried to identify a few measurements we think is most relevant to the sector. And in all of our carbon transition assessments, we make sure that we select indicators of risk that are most relevant for that sector. So the indicators of risk that we pick for utilities will be different than what we pick for refiners or for autos. But the framework is consistent. We look at 4 things: the current low carbon transition plan, by looking at the extent of fossil fuel generation that these companies are exposed to and their utilization rates. We look at the exposure to policy, technology, and market risks. We look at the medium-term response over the next 5 years. And we look at the long-term response over the next 10 years with respect to planned retirements and closures. What I like about that is the carbon transition evaluation for market and technology and policy exposure. These are the big game changers for the sector, because things can happen there that can really accelerate the transition faster than people were expecting. And what we try to do is create this carbon transition framework so that we can differentiate amongst companies within the same sector and speak to the marketplace with a single voice. Our framework is prospective in nature, and yet it's individualized by each different sector. We have an expectation that the utility and power generation carbon transition framework will be outstanding for anywhere between 45 and 60 days for market commentary, and I encourage everybody to please get a copy of it by the time this presentation is being made public. That request for feedback should be open, and I encourage you to talk about it. Now on the next slide, as I try to bring it in, how the utility sector is going to withstand to this, it's very well positioned. The utility sector has a business model that we find is very resilient to near-term shocks, and the utility business model is a critical component to the successful decarbonization efforts that are underway. Utilities have already claimed this central role because of the critical asset nature of their businesses and service. Utility business model is underappreciated in terms of the energy transition because it has the ability to move the needle materially, more so than other sectors can. Even though relative to the equity markets, utilities are pretty small relative to the equity markets. They have an outsized impact on decarbonization. Now the business model is largely driven because there's a good alignment between what the utilities and power generators are looking to do and public policy. Having said that, we do need to watch for this creeping leverage that is coming in here. The cost of capital is very attractive for utilities, and there is a heavy reliance on debt right now. So we have to watch how these utilities are moving, they're weakening their balance sheets as they continually rely on debt. As a rating agency, I just want to remind you that we don't make buy or sell recommendations about companies. We simply provide an opinion about credit risk, the probability of default, and the loss given default. Our objective is to rank order this credit risk. Now, with consideration, we try to consider lots of different risks as we do this. And when it comes to carbon transition, which is a longer-term risk, we do observe that even though it is a longer-term risk, we still need to talk about it today in our credit analysis. And we're very focused on providing our analysts consistent data that's verifiable that we could use across our 1,500 analysts globally. With respect to the coronavirus and the impact on the utility sector, we recognize that greater visibility over the depth and the length of the current crisis is necessary in order to fully appreciate and quantify the impacts on the sectors. But we say the utilities are well positioned, although not immune from these near-term shocks. We're following our normal approaches even during these abnormal times. For investment-grade issuers like utilities, we see the stronger business profiles, we see the stronger business plans, and the better access to capital. And so we're looking for the management teams to get their business plans back online over the next 2 to 3 years. So 2020 is going to be a bit of a look-through from a credit perspective. And as a firm, our official stance is to provide the strongest companies with this runway to get their business plans back online, because we only want to take rating actions on those companies that have been permanently or more severely affected. So that said, given the market turmoil that's underway right now, it's a good reminder why it's important for utility companies to maintain a healthy amount of financial cushion above where their downgrade trigger thresholds are.
All righty. Excellent. Well, thank you, Jim. Good morning, good afternoon, however it may be. Thank you guys for taking the time first off. So Julian Woldsmith, again, B of A, we rate equities, right? We basically rate the stocks, buy, sell, hold. At the end of the day, we recommend to investors where to put money, right, at the end of the day. So I think that's a good way to at least introduce where I'm coming from. And I think in past years, and obviously today, this is a little bit, perhaps awkward, I've tried to engage a lot with you in conversations more informally across the group to try to debate the core issues here. So we're going to try to do this hopefully a little bit, hopefully somewhat effectively. And I'm going to try to hit on at least some of the topics in past years people have been interested in and from our vantage point. And again, I want to start out with the context that, yes, we may be rating stocks, but the point is, in order to understand what's going on with the stocks, you have to understand what's going on with the industry. And in order to understand what's going on with the industry, you need to understand what the fundamentals are going on and where the puck is going and skate towards it and understand how what the ramifications are for investments. What are good investments? What are bad investments? How do you identify those on behalf of investors, right? That's what we're doing here. And again, for context, we deal with, we're not just dealing with the utilities here. We're dealing with utilities, power companies, clean energy companies, manufacturing companies, et cetera. So we're trying to take a holistic view as to what the best set of investment opportunities sitting here are today, right? So maybe at the outset, as I've done most years, let's talk about the technology background, right? I think a lot of times folks in the policy world, in fact, let's be honest. I think most people just miss and completely miss out at how meaningful of an underlying improvement we see in technology consistently year in and year out across all veins of the different energy technology here, right? So at the outset, I want to stress that, a lot of the focus that we've had of late has really been around the storage technologies. What dollar per kilowatt hour can a fully packaged cell deliver on an ESS or stationary storage basis? that's an open question. In recent periods, we're talking about low 200s per kilowatt hour on a grid scale basis. Admittedly, it's much higher on a distributed basis, but the point is, I think that is enabling in future delivery years a much more competitive backdrop for storage products. And I'm not saying that they're necessarily competitive in capacity markets. That's not what I'm saying. But what I am saying is that from their deployment perspective, we're seeing categorically almost every RFP bid with solar and storage. We are seeing conversations in mass to go back and talk about how do we include storage in products that we've already sold and deployed. And again, maybe this is a good pivot point to talk about in brief the tax credit scheme. So let's talk about policies. Let's talk about federal policies, right? And again, I think in the past years we've talked about ITCs and PTC phase-outs. Let's talk again today, right? Again, I think there's a lot of talk about legislative actions next year, et cetera, et cetera. The point is, what we're looking for next year, if there is a change in administration, is a potential extension in the phase-out. The real question is, right now on the solar side, to start with, you've got a 30% cliff, right? So the question that we're looking for is whether that 30% gets extended, right? Do you have a phase out on a 4-year basis as well to commence construction on solar to qualify 26 and 22% in 2024 and 2025 respectively, at a minimum, right? That would seem not to require legislative authority, and frankly could just be done through IRS interpretation of law. So I think those are some of the critical points that would effectively add a couple years of meaningful solar deployment to the industry, especially when coupled with the prospects of continued solar price deflation. And by the way, let me make it abundantly clear to folks, solar panel price deflation remains very clear. Last year, when I did this very same presentation, we showed dramatic deflation year over year. And we've done this several years in a row. And again, this year, we're going to talk about the same fact pattern. And again, I'm going to roll it forward to 1 or 2 years, and we're going to talk about N-type manufacturing, what that means for the next wave of panels, what you should understand about the so-called bifacial panels. This is a double-sided panel that a lot of folks have been talking about how that adds 5 to 15% efficiency. So forget about the price of the panel quickly. Understand that the efficiencies of these panels are also improving as you think about what their characteristics are. So, across all of these different veins, that ultimately is bringing down delivered PPA prices. And that's my point. And separate and in tandem with that, let's also talk about the other big policy question, at least that we're seeing from our side, that is a stationary storage battery credit, right? The question is the federal government going to pursue a stationary battery tax credit? And again, that would substantially ease the ability to go back and upgrade existing sites with stationary with storage. And again, I think that's what a lot of the big players like NextEra and others are looking to do, especially given their existing wind portfolios, which obviously don't have the benefit of being able to site solar and storage with the same tax credit. You don't have that ability with wind. So we'll see what happens in the future. But again, pay attention for that one very closely. That being said, just to start to opine on sort of the news of the day or the news of the hour, if you will, I just want to make sure that folks are aware. Obviously, Vivint and Sunrun merging here, creating even more of a powerhouse in the distributed solar world. Again, I'm not necessarily going to fixate on utility scale. I know a lot of folks here are fixated on, that's why we're going to talk about it, but I do not necessarily want to undercut what is happening on the distributed front, because that in and of itself is accelerating, right? And accelerating not just in the resi context, but clearly in the C&I context as well. And I think reliability characteristics, as emphasized by the storage products, are also in parallel encouraging a lot of the adoption a la California. So let's keep going. One other point, again, this goes against the grain, I think, for a lot of folks, but let's talk about it, right? Let's talk about COVID. Let's talk about tax reform. This is going to be the potential issue when we think about reinvestment in clean energy in the coming years, right? The point is that you could potentially have inflationary impacts on customer bills resulting from COVID and the need to go back and recover some of those costs over the coming years. Depends on what periods are amortized. And secondly, the other big potential impact on customer bills that would impede the affordability of renewables is going to admittedly end up being tax reform, to the extent to which that is in tandem contemplated in the future legislative session at the federal level next year. So folks should be thinking about that and how to position that, because I think those are going to be very tough pills to swallow. Admittedly, I think from a utility perspective, I think a lot of folks are asking, how do we go back in and how do we raise capital in this environment and go back in for a rate case at present? Certainly, authorized returns remain somewhat challenged in that context, and I think that's one of these big questions that we're looking at today. So let me move on to another point that Jim really highlighted, and that's ESG, right? Environmental social governance. But the point is ESG investing, right? And you've seen a significant disconnect, right? In fact, the single most pronounced investment factor, as we call it in the industry, that is driving successful investments is pro-ESG investments, right? Literally, that is the single biggest investment strategy we're seeing across the entire market for active investments. And what that means is we're seeing a substantial bifurcation in the valuation, in interpretation for you all. The discount rates being applied to clean energy assets versus energy assets is very different. To be much more specific about it, right? We're seeing returns on levered on equity, levered returns on equity as low as 5% on clean energy assets relative to 10+% in some of these other energy-oriented assets, right? So you ask yourself, now I'm not saying categorically, but high single digits is probably a good way to think about it. And again, you have a big bifurcation in what that cost to capital is, because capital wants to go towards clean energy. And again, let's be very clear about this. The single biggest secret sauce in making renewables work is low interest rates. Think about the backdrop that we're in today. We're seeing the lowest ever interest rate environment cycle in U.S. history, basically. So when you think about this, we're looking at a backdrop that's incredibly affordable for energy. Again, the point is, if you invest all this capital upfront for solar and you got to amortize that over time, having a low discount rate with interest rates is critical here. So again, I want to leave that point because that's really important when you think about how you can get PPA rates lower over the near term. A separate point, let's start talking about some of the discrete states. I think a lot of us like talking about that in the past years. I think let's talk about, when we talk about ESG here, I think what's really important is companies are stating big targets. And the question I think many of you ask is how do companies actually achieve this given what they're proposing today? And I think the point that I would leave you all with is, yes, it's very thorny. How does a company go out with a corporate ambition to hit what investors and the rest and what many other constituencies would like to see, while dealing with the practical realities on the ground in certain states? And I think, for instance, just to pick on it, right, you have Duke out there with stated targets that are meaningful in terms of net zero reductions in decarbonization. And I think the reality is, as you think about them, is they're going to have to break apart, right? What does Indiana want to do versus North Carolina? And I think you're going to see very different results depending on the specific states. It comes down to what is palatable for regulators here, I think is really important to understand. But again, North Carolina, Indiana, watch that for Duke. I think that's relevant here. Other things, watch the election, right? So Arizona, critical here. I think you are poised to see some real shifts in how that state views things and the conversation evolution that we've seen past tense. I say it now, mark my words, maybe I'll eat them later, but I think let's watch how to make that work. New Mexico being a good example. The success of securitization here is going to be critical in making this palatable to utilities. I think lastly, again, we talked about North Carolina. Let's talk about other examples here to focus on in the next year, right? So I feel like every year we come back, we talk about securitization. What about securitization legislation in Kansas and Missouri? What about that applied to the context of Evergy, where obviously you've got rates that are relatively high, driven by some of the coal investments on the margin, right? So over the last decade, right? And so there are other contributors there, obviously, but I think that's going to be an important paradigm to watch by other states as to the success of those specific efforts to actually drive customer affordability. Can you actually thread the needle carefully such that in a low interest rate environment, you can actually drive customer reductions, enable securitization, and ultimately drive the transition here that we're talking about? So I think that's critical. The other one I would mention is Dominion here, right? We saw Dominion divest basically what was a large energy company 20 years ago, its large midstream and pipeline business, and really opt to do that because the investment opportunity in the clean side in Virginia just became so large that it became obvious that they needed to break this company up effectively, right? And so I say obvious because we predicted this transaction would happen on the margin. So again, I stress that's been out there. Another couple points before I wrap up, if I can. Gas assets are going to continue to decelerate. You're going to see this very clearly in the PJM auction results next time they actually happen. We're going to see the last wave of new asset builds that were contemplated past tense a while ago. We're not going to see it in New England. We're not going to see it in MISO. And that itself speaks for where we're seeing elsewhere, right? The reality is for the Southerns and Dukes and Dominions of the world, we're going to see revisions to their IRPs that are going to result in less gas. And less pipeline availability means it's more expensive and on the margin, less gas. So I think altogether that's going to be the series. And the question is just what vintage of IRP are we looking at? So I think if I were to close out with a couple more points here, tax equity is critical. I think when you think about NiSource, Alliant, watch these companies and the success for them to get successful regulatory treatment about implementing novel structures that allow for investments in solar by regulated utilities in rate base that take advantage of tax equity that make them palatable. You want to get the industry incentivized in the right direction. Getting the regulatory compact is right. Getting the regulatory capital structure and nuances on solar is so critical. And watch Iowa and watch Indiana critically, because not only is Indiana going to be interesting from a coal perspective, it's very interesting from a solar perspective. This is one of the most important states to watch this year. So if I can close on one further point, there's a lot of capital coming towards the sector, whether it's, and when I say this sector, I'm saying specifically clean energy, right? Energy investors are seeing this too. ESG is a thought process across the entire energy spectrum. And I encourage folks to be asking, what does hydrogen mean in the context of gas LDCs? How do energy companies play into this transition? How do pipeline companies play into this? How does safety play into that? And then how does energy capital directly come into this clean energy space? Because again, that drives just down lower this ultimate cost of capital in the space. So again, we can talk about a range of things. I know there's a bunch of questions, and I'll turn it back to Liz with that. Thank you all very much.
Thanks, Julian. And thanks too to Jim for his presentation. I think we're going to bring back, there we go. We got Jim here too. And we've been getting a lot of interesting questions on the Q&A function. And I'm going to just start firing them off here. The first question that I want to start with is one from Mary Cirilli from Mothers Out Front. And she's asking, how can you explain utilities like Southern Company, Dominion Energy, and Duke Energy, who are making investments in new gas plants and pipeline infrastructure without considering the risks of stranded asset potential from fossil that will outlive the company's 2050 climate commitments, and without considering the climate impact of upstream methane leakage, which hopefully companies would also be attempting to quantify and include in their carbon plan? So I think that's probably a good question for both of you. Can we start with you, Jim?
Sure. Thanks, Liz, and thanks, Mary, for that question. You know, from a rating agency perspective, we think about stranded assets between the stranded asset risk that might exist and the stranded asset exposure that might exist, right? So some of these big utility companies might have a lot of stranded asset exposure to their assets, but we don't think they have a lot of stranded asset risk. And what we mean by that is the vast majority of the situations we've seen, the utility regulators have allowed recovery of these assets, in some way, shape, or form. So the impact of a large impairment or a write-off is relatively low, in our opinion. But we also see a transition in the way they're investing their capital. And so we see more and more capital moving into renewables and energy efficiency and grid hardening and away from fossil-based investments. Julian, do you want to?
Yeah, let me add a few specifics here, right? Because there were specific companies identified here, right? So listen, the here and now about stranded assets, I get, is really going to be scrub coal, right? And so that's why I'm so fixated on Kansas. If you look at the sector, the company with the highest percentage of rate base coal in its rate base is Evergy at about a third of all of its rate base. So that's going to be the high watermark. And that's really what we're going to be focusing on when it comes to stranded assets and securitization and the ability to carefully thread that needle. That's why I'm going to say it. I'm going to double down on it because it's so critical to the industry. Now, specific to Southern, right? We've got Alabama already long-standing having plans on gas, right? And so does this reconcile? No, I'm not necessarily saying it does. But I'm saying that the ball has been rolling already. And so the question about when this decision was made and how do you back out of it, that's the difficult decision. And that's the precarious one, right? So when I talk about vintages, watch that carefully, right? So Alabama was already moving, number one. Number two, I would stress that on the margin, if you're looking at another state, right, you might point to North Carolina, where you probably will see revisions on the margin. The question is, how dramatic are those going to be? And again, my emphasis, again, goes back to, what is the asset, what is the depreciable life that's going to be assumed for recovery here, right? What do you do to backstop the grid on intermittency in the 2040s? Open question, right? And so how do you balance that? Again, I get it. I don't think there's a better way to talk about it, but for understanding that companies like Duke are going to have explicit updated disclosures and comprehensive investor conversations this October on how they're going to reconcile those climate goals against their IRPs. And those IRPs, by the way, happen to be poised to be updated in September. So it's interesting timing as well. And then lastly, on Dominion, I want to stress, with ACT not happening, you could potentially see changes as well. It's unclear exactly what that means at present. But again, stay tuned. There is so much renewable investment going into Virginia at present, at least as contemplated. It's really hard to sort of understand what that fuel mix is looking like at present after this recent legislation. So on all 3 points, I think you come up with a different outcome. And I think in Georgia, again, I don't necessarily think you're going to end up with more gas there.
Thanks, both of you. I'm going to move on to another related question about securitization. And this question is from my colleague, Tyler Cummings at Applied Economics Clinic. And he's asking, how do you see securitization to address stranded assets of retiring assets? How do you see it affecting utilities' credit rating?
So thanks, Liz. So securitization is one of the financing tools that utilities can use, and what we've seen more recently is a very significant increase in the pursuit of the enabling legislation for securitization to cover a lot of different topics and cost structures and things of that nature. So we think securitization is going to become a more popular tool for the utility companies. It is a benefit to the companies because they get to get the capital back that they're seeking to get right away, and then amortize it over time with what is essentially the lowest, cheapest cost of capital that's available to them, which is the AAA securitized structure. What we see happening now is the securitization started in the late 1990s. I think it was Puget Sound Energy that did it originally with environmental costs. It moved into stranded assets during the deregulation period in the mid to late 1990s, which is an accounting provision. And now it's covering all kinds of storm costs. There was a reactor that they used in Florida. But now we see wildfire resiliency costs seeking to be applied to securitization, like with Southern California Edison. And other types of COVID-related expenses are being discussed about it as well, as utilities defer shutoffs with their customers and other various different issues associated with the social risks of that particular scenario. So from a credit perspective, if you overdo securitization and securitization cost, the cost of capital of the securitization debt becomes a very large component of the customer bill, we believe that there is a tipping point where utilities will have more contentious discussions with their regulators about getting other cost recoveries through the regulatory process, because there's only so much that consumers are willing to tolerate before they really start to object to those types of recoveries. So we think securitization is a credit positive for the companies because of the cost of capital, the impact on the customers, the ability to recover right away. But too much of a good thing with anything, whether it's hybrid preferred securities or securitization, could tip the apple cart on that. And we think securitization will be a much more significant part of the dialogue going forward.
And Julian,
only point I would add here is, securitization is a great tool, as Jim mentioned. I would also recognize securitization often requires legislation in most states, or maybe not most, but many. And I think that really impedes the ability to pursue it. And frankly, I think the reality is let's get ahead of this. And I think many companies that we're talking to are looking at this in the context of accelerated depreciation. Let's change what year the assets are poised to retire ahead of time. Let's get ahead of these issues. And that's what you're going to see as probably some of the most thorny issues in most of the rate cases coming up, because that's being proactive. I think everyone wants to be proactive about this. And so to a certain extent, I think that's going to be the reality of the case. That being said, listen, securitization is not necessarily being done in the same way everywhere, but I think at the end of the day, it is a low-cost solution, and that's why it's sort of pervasive, if you want to put it that way. And I'll pass it on.
Okay. Thanks. And we're going to go on to another question in a little different direction. This is a question from Bill Wheel, and he's with Tempest Advisors. And he'd like to hear both speakers' perspective on a study that's come out from Grid Lab, Energy Innovation, and Berkeley, if you've seen it. And it shows that utilities can reach a 90% clean energy by 2035 without raising rates.
So I'll go first if that's okay, Julian. I have not seen that particular study, but I have participated in a lot of the discussions and think tanks, conferences and things of that nature. And what we are operating at, the utilities team, the North American utilities team at Moody's, we think that getting to that 80 to 90% clean power grid is something that is able to be achieved relatively easily from a desire perspective. Right now, there are hurdles to making those investment decisions, to having the incentives and getting all the alignment of the stakeholders in play. And it's that last chunk, that last 10, 15, whatever percent, that's extraordinarily expensive. And we've heard this over and over from a number of the utilities as well. So it sounds to me that the premise to the question from this particular study is consistent with that view that getting to a relatively carbon-free grid without having significant rate increases, because of what Julian was citing, is the significant reduction of the costs and then the benefit of the capital costs. The capital costs are going to be compared to either one of those power sources, whether it's fossil or renewable or non-carbon emitting. That's where the issue is taking place right now, because you can continue to drive these efficiencies and these investments and maintain a relatively flat revenue requirements expectation.
Julian?
Yeah, I mean, I don't want to add too much and to be repetitive. I think the only point I would stress is I would encourage folks to think about the sector as fundamentally a technology-enabled one, right? Automation is kind of the underlying theme here, if you want to use that word, because I think it inspires certain understandings, and understand that suggests that deflation is a reality of the sector, and that enables new technologies to solve solutions in the future, right? And that's practically what we're seeing. Now, to deal with it in the present tense, I think it's been miraculous to see how much cost has come out of the industry net of all the investment, right? Again, I want to stress that net of the investment. So, I'm not perturbed per se, but certainly it's a challenge ahead. And again, I think that the underlying premise would say there are other solutions that will materialize, I suspect, over time. But again, don't be wrong. I think bill inflation and the cost to achieve it, I mean, in the here and now is going to be problematic next year. And companies are going to try to delay and play awkward, potentially be as awkward as I am being right now in trying to avoid rate cases. So I'll leave it there.
Okay. I'm going to ask now a question from Vanessa Warheit, who's with the Fossil Free California. And she's asking you about sort of how you're thinking about renewable energy, if it's within the energy sector or across all sectors. So her question is, are you assessing renewable energy companies within the energy sector or the tech sector? If the energy sector remains entirely fossil fuels, then intra-sector comparisons don't help us to assess the long-term viability of fossil fuels. Can either of you touch on that, sort of how you're positioning renewables when you're assessing them?
Sure. So for Moody's, if an issuer, we call them issuers, right? Because they're companies, sometimes they're projects, they might be state and local governments, whatever. But the issuer comes to Moody's and asks for a rating on a particular transaction. And when they do that, we have to evaluate the structure of the transaction and decide where it belongs. Okay, so is this a project financing where there's various cash, waterfalls and things of that nature? Is it a corporate and things of that nature? Is it some kind of structured deal? That will say where it goes within the organization from a rating, which rating team will do it. But renewable energy is viewed as part of the energy and power sector. So it would really reside. I would estimate that the vast majority of anything renewable related should have some participation from the utilities team, because we have a significant amount of renewable energy expertise across our firm globally, right? So we have a renewable energy task force that's been in place for 10 years. That includes everybody in Asia and Latin America and across the European region, as well as North America. And we are constantly looking at the cost curves coming down and what's happening and where the investment is going and how people are structuring these transactions. If there is tweaks or unique aspects of a particular transaction, we would bring in the expertise that we need to bring in. So whether it's a legal expertise that we need to bring in from one of our legal experts, or a structuring component, that we would bring it in that way. And if it's a state and local government behind the project, we would have our public finance team there as well.
Julian?
I'll pass it back to you, Liz. I'm not sure exactly how to answer it, right? I mean, maybe they can clarify the question. I mean, from my perspective, yeah, we consistently assess renewables, but maybe the intersector nuance, I'm not sure I fully grasp in terms of what they're seeking to understand. Yeah, I mean, I think I'm going to reiterate this point about discount rates and differentiated views. Different sectors have differentiated views, but if they can clarify, if Vanessa can clarify her comment or question, I'm willing to engage.
Sorry,
Liz, I think you're on mute.
Yeah,
Can I do one other follow on that?
Go ahead.
One of the things that we are, like, in terms of intersector comparisons, one of the things that we're very excited about at Moody's is we have recently published our third sector specific carbon transition framework publication. That was about, I'd say, within the last week or so. And if anybody's interested, you can go to the Moody's website, and there's a webinar coming up where we'll explain it for power generation. And so it's all publicly available. Everything is disclosed. We put our report and our framework out for public comment, which goes until, I think, sometime in August. And then we'll have our final framework. We have our final framework on refining, global refiners. We did our final framework at the end of last year for global autos. And what we're trying to do is assess this very specific element of carbon transition risk and how it applies to different issuers within a sector, right? So we have our environmental heat map that talks about carbon transition, but on a sector by sector basis globally, right? $75 trillion worth of debt across all these different sectors. Who's most exposed versus least exposed? Now what we're trying to do to get to that granularity is say, okay, within a given sector, the auto sector, for example, of the 25 or 30 rated auto manufacturers that we have, who is most exposed to least exposed to carbon transition risk, right? So Tesla is the least exposed to carbon transition rate. It has the best carbon transition assessment score that we can give anybody right now. It doesn't have the highest rating, but it has the highest carbon transition exposure, meaning it has the least amount of carbon transition exposure. So we just published it on generation, and in the generation will be some companies that are very highly renewable, and you should see them bubble up to the top of being least exposed to carbon transition, because they're primarily a corporate or a structure of all renewable energy type sources of power. So thanks, Les.
Sure. Oh, thanks for adding that. I'm going to go to a question from Meredith Wingate of Energy Foundation. Is the carbon transition, this is for you, Jim, is the carbon transition assessment, are those results publicly available information? Are the underlying data associated with the exposure investment risk, are they available?
Yes, and so, well, yes and no. Yes, for those that are done are available. So for autos, for example, they're available. We just finished and published the final framework on global refiners. And then we just published our proposed framework for power generation. So each time, each sector we do, we identified a dozen sectors that are most exposed to carbon transition, and we're just slowly ticking through them. You'll see major oils coming out here, perhaps by the end of the year. It's a global assessment framework. We identify where we get the data from. And so all of the data that goes into our carbon transition framework is publicly available data that is either sourced directly from the issuer's publicly available statements or filings, or from a what we believe is a reliable third-party provider of that particular data. The reason why we are so strict on only using publicly available data when we create these carbon transition scores across companies within a sector is we don't want the benefit of material non-public information leaking into the assessment, because then it's not an apples and apples comparison. We want to be able to compare Ford versus GM versus Tesla on an apples to apples basis, and we don't want the individual analyst to have the knowledge that they may have influence what we're saying about that score that the market can't see. And so we publish our framework proposal. We open it up for comments. Anybody can comment on it unless you're a Moody's employee. We take those comments back online, and sometimes we tweak a few things. And so, for example, in our corporate governance framework that we did for non-financial corporates, we made a few adjustments on that to incorporate diversity and cyber questions in there based on market feedback. We'll see what I expect a lot of feedback on the power generation one, but in everything that we do at Moody's, whether it's a credit rating where we have our rating methodology and all of our individual indicators readily available, or these carbon transition frameworks that are non-credit rating assessments, it's a different categorization. We want to make sure that we're only using verified publicly available data, and then we always make sure everything is available to the public so they can check our work.
Thanks, Jim. So we clearly have more questions here than we're going to get through in our hour. I'm going to start putting some of the questions that are getting a lot of likes to the top here. And so remember that you can like questions and go on in there and do that. I'll take a question now that's gotten a bunch of likes from Brendice Woods, my colleague at Applied Economics Clinic. And one moment. She asks, can you address how utilities are planning to reliably integrate large amounts of renewable energy? What role do load flexibility resources like battery storage, demand response, virtual power plants, those sort of things, what role do they play in utility planning? And how does that relate to credit scores and so forth?
Julian, do you want that one, or?
Yeah, so I mean, I'll be brief about this because I know we don't have a lot of time. So I mean, listen, clearly we're early stages, right? I don't think that there's a full appreciation as the full extent of the opportunities enabled by the load flexibility, especially with stationary storage dynamics. And you know, perhaps I say the obvious that not only is there deflation, but I think understanding the operational characteristics and perfecting the operational characteristics for stationary storage applications from what is effectively an electric vehicle oriented industry is an evolving science in and of itself. So I think that's important. That will help over time integrate the renewables. But again, the backdrop here, and maybe let me plug hydrogen again, because hydrogen is a major backdrop to what an energy conversation in parallel geographies are now talking about. And again, that's a big one in the context of integration in solving the storage problem in parallel with the decarbonization problem in the longer term. Not a silver bullet, but it's definitely part of it that wasn't specifically mentioned, and I think merits some conversation here. That being said, listen, demand response, clearly, energy efficiency, clearly, virtual power plants in a distributed context, clearly. But the question is designing those tariffs adequately. Again, I think we're finally reaching critical mass where we can actually do things like VPPs on a distributed basis where it makes some sense. But yes, it's very early days. I mean, I at risk of stating some of the early integration models, obviously Massachusetts, California is what you want to watch. Admittedly, at the end of the day, we'll stress this. I'm not sure grid services like virtual power plants are going to drive on the margin new investments in virtual power plants. So I don't want to overplay that, and I'll stress that last point. But again, obviously, load flexibility from a battery perspective remains an ongoing point. Watch the science, watch the characteristics improve. Obviously, watch as the deployment costs plummet over the next few years. And in light of potential tax credits, that's where you're going to see substantially different choice fact patterns. And that's why the vintage of these IRPs is going to be so critical.
Jim, did you want to address that too?
Uh, um, no, I think I would say something repetitive from what Julian
Um,
just said, with the
Let
exception
me
of the
go on
hydrogen.
then. So sorry. Let me go on then to another question that's getting a bunch of likes here from Patrick Robbins. Many utilities seem to be simply baking COVID debt into their rate cases as their plan for recovery. Is there a potential here to set off a vicious cycle? How are rating agencies thinking about this with respect to utility credit ratings?
Right. So, okay. So first of all, utility credit ratings, utilities are critical infrastructure assets. And if you look at our default studies, critical infrastructure assets default at roughly a 4.5 times lower rate than non-financial corporates. So right off the bat, they tend to be strongly investment grade entities that have the ability to withstand a lot of shocks to the business model. And that is primarily because, unlike corporates that earn margins off of their revenue, utilities earn their income and operating margins off of the investments that they make, their cost of capital recovery. So what we have been doing at Moody's is, when it came to the coronavirus, we are trying to apply our normal procedures during abnormal times. So we did a global portfolio review to identify which companies are more exposed than less. And when it comes to investment grade utilities, we think that the business models are relatively resilient depending on the duration of the coronavirus. And so for utility companies to defer costs, defer expenses and things of that nature, hang it up on the balance sheet as a regulatory asset and recover it later, bake it into the debt, that is a good thing, because a lot of companies don't have the benefit of doing that. So it's a huge benefit for the utility sector. Now, if you have a lot of utilities that we have in our portfolio are already sitting on their downgrade trigger, or they're below their downgrade trigger. This is something we've been highlighting, I think last year at your conference, we highlighted this issue. But there's not a lot of cushion for that. So how much time will a company have to get their business plan back in order after this unique and unexpected black swan event called coronavirus? And so we're trying to be patient. We're trying to be measured in our approach on this. And I think you'll see us give the sector a significant amount of time to get them through there, because the probability of default is not necessarily rising if the debt is going up because of coronavirus, which is part of the regulatory compact, because you're helping your customers and the people that you serve, without having to put on additional revenue increases.
And Julian, you might have an answer to that, but I want to sneak in one more question before the end here, and maybe you can take it first. This is a question from David Pomerantz from the Energy and Policy Institute. Political battles over building electrification are heating up at the city and state level around the country. Aggressive building electrification policy would seem to be a big load growth opportunity for electric utilities, yet most don't seem to be doing much for those fights. Do either of you, and we'll start with Julian, have an opinion as to why that is?
I don't have a strong one. I mean, admittedly, right, I think what David's getting at is much more specifically the electrification opportunity of decarbonization of the gas industry, right? I think, is there a relationship? I'm not sure, right? I mean, it is intriguing at the same time. Obviously they're focused on economic development opportunities, which really drive a lot of electrification as well. And frankly, in a lot of instances outside of building standards, I think the stress point that we're going to have here is, I think the underlying point would be, not only is it economic development, but it's also, what about EVs, right? And the opportunity there, I think a lot of it just is not ownable or investable or incentivizable necessarily by the context of the utility, right? It's driven by other parties. So maybe I don't necessarily fully agree with the premise, because I do see other opportunities that they're pushing. But admittedly, the conversion one is an intriguing one over time. The open question is it economic necessarily to pursue electric over gas, depending on the context? I understand heat pumps. We can have a separate conversation about that. But I think in the context of electric versus gas in a head-on-head debate, that becomes trickier, obviously. So I'll leave that there. The other comment I'll make, listen, in the context of COVID recovery, let's be very clear. We have not seen material filings, right? Again, COVID impacts thus far have been more palatable than what I think people have understood. And again, palatable is a relative term. And so I think that helps to de-risk some of this. Obviously, Turning payables into bad debt itself is a process over time, but admittedly, the very early data that we're getting in the last few months would suggest that it's not as bad as contemplated. For instance, if you want empirical evidence of this, look at New York State, where they are not necessarily granting recovery of COVID costs in any kind of formulaic way or any kind of rider adjustments, et cetera, et cetera. And New York State allows utilities to go back and file if they trigger a certain amount, and they're not filing because they're not triggering that amount of anticipated spend. Direct COVID-related expenses, which might be a slight twist off of bad debt expense at present, because you might not necessarily be able to anticipate the full level of it. But that being said, even if you go back to what bad debts were in the last global financial cycle, admittedly much more palatable. So I don't think these are the end-all be-all. In terms of bill impacts, tax reform probably is the bigger one year over year in 21, if that's indeed what's going to happen. Again, none of this is good news for bill affordability, unfortunately.
Thanks, Julian. And I'm going to have to close us off there for the questions. I think we had a really great discussion, and there's even more of an interesting discussion going on in the chat and the Q&A that I think is a great benefit of doing the conference in this manner. It gives you a whole another chance for communication. Thanks everybody for joining us. I think that I will thank both Julian and Jim so much for your great presentations and ability to answer these questions on the fly. And I think that I am sending it back to Sandy to close us out. Hi, Sandy.
Hi. Well, thank you so much, Liz, Julian, and Jim. As always, a lively conversation. And as Liz mentioned, there's opportunities, and we hope you'll take advantage of them in the conference website, where you can keep going with chats. You can also set up separate networking meetings with folks that you see online. So please take advantage of that. And we also hope you'll take advantage of another feature of the conference website, which is a section that you'll see on the homepage if you scroll down in the center, called Local Leadership Global Change. And there we are profiling a number of extraordinary organizations around the world who are working to accelerate the energy transition in their communities and countries. This week, you'll see a feature there on Solutions for Our Climate, a nonprofit organization in South Korea. We also hope you'll join us again here tomorrow at the same time, where we'll have our next session, which is called Accelerating the Global Capital Shift Away from Fossil Fuels. We hope to see you then. Thanks again.
Solutions for Our Climate is an environmental nonprofit organization that focuses on climate change issues, especially energy transition, power market restructuring, and greenhouse gas policies.
We're an organization that uses research, advocacy, and litigation to lead our society to a 1.5 degrees compliant society. In Korea, coal is about 30 to 35% of our national greenhouse gas emissions. We only have 60 coal power units, which means that one coal power unit emits about 0.5% of our national emissions. It's a very good strategic target because there are very cheap alternatives to coal power. Solar and wind power is a great example. It's a low-lying fruit in the climate world, so that's why we first focused on coal. The Paris Agreement says that the world should keep its temperature rise below 1.5 degrees. Drastic changes will be needed for us to meet that target. That means that we have to get rid of all our coal power by the late 2020s. It also means that we have to get rid of a lot of our gas power before 2050. Of course, our country isn't going toward that direction. We still have a lot of coal power plants under construction, a lot under operation, and then we are exporting a lot of coal power plants to countries in Southeast Asia. On top of that, we also are planning to build a lot of gas combined plants, and this is all going to be a tragedy to our climate and Earth. The first topic I worked on was coal financing, and that led to our initial funding and initial support. And in 2017, I was the sole person. Now we have a team of 17 people.
다음 주에 아마 그냥 주진님이랑 뭐 몇몇이 한번 콜하고 그 다음에 일정 잡아서 내부 세미나 정도.
It's a puzzle because the problem itself is huge, and there's no one silver bullet that will solve everything. So we have to go on a very granular level. We have to fix this, finance, policy, economics. So all of that combined becomes a whole solutions for our climate.
발전소에 관한 문제를 오랫동안 제기해 왔는데요. 오늘은 그 절차적인 문제에 대해서 문제 제기를 하려고 합니다.
At first, I thought the legal measures are most important. As a lawyer, I thought I could really fight with these licensing agencies and company with litigation and other legal measures. But while reviewing the documents and legal processes, I realized that it's more important to build social consensus. So we begin to communicate with more people about how irrational to build new coal at this moment in Korea.
여러분, 모기가 해외 석탄 사업에 600억짜리 빨대를 꽂으려고 하고 있습니다. 그런데 순간 예타 그물망이 중간에 바로 막습니다.
For many policymakers, climate is too remote a subject for them to put their stamp on. But when you talk about money, when you talk about how financially problematic this could be, how a certain decision in a fossil fuel business could expose the nation or a certain board member to liability, is a very powerful tool in changing decisions. In many cases, people assume that fossil fuels are cheap. It's very economic. It's very reasonable to make these choices. What AIFA has done is reveal that reality. And with the facts that AIFA provides, we go in to meet our bankers. We put those facts in front of board members of important utilities. Their work has been very helpful for our work here. Last year around this time, our government was planning to retrofit our coal power plants and extend their life periods by 10 or so years. 10 years more to like 15, 20 coal power plants is a lot of emissions. That's an annual emission of a major economy. And our government was planning that. We brought in a lot of partners and we made a fuss about this thing. And with that, the government surrendered. They said, no, we're not going to do these retrofits. Which that in other words means that we're going to close these coal power plants in not that long a future.
3, 2, 1, we see those progresses, those changes into governmental policy. And we are seeing a slow momentum towards the coal phase out in Korea.
Youth for Climate is a youth organization. Teenagers in Korea, middle school and high school students, they started going out to the street and making demonstrations since 2018.
When I was 16, I learned about the climate crisis and I realized that it wouldn't be enough to simply wait for the adults to solve the problems, that we just didn't have enough time for that.
One of the initiatives they had was they wanted to sue the government because they're not taking sufficient action on this issue.
When we first started talking about the possibility of a constitutional claim, we weren't sure if something like that would be possible in Korea. Something like that, as far as we were aware, had never been done in Asia before. But Solutions for Climate told us that it actually was possible. They have been the legal specialists in developing the case and realizing it into an actual constitutional complaint that could be filed to the court.
We have prepared a constitutional case and we filed it in March 2020 and the actual advocacy is in the court now.
Our claim is that the government's insufficient climate action actually infringes on our constitutional rights, such as the right to life and the right to a clean and safe environment. our lawsuit actually passed the preliminary review for adjudication 10 days after we filed the complaint on the 13th, which is a remarkable achievement considering the usual timeline of the Constitutional Court. We're confident that the public attention on the case has pressured the bench to process the case so swiftly.
When we talk about climate change, we always talk about by the end of the century or in 50, 60 years. But when we put a face on that timeline, that's our children, that's our grandchildren, it really becomes real.
When I think about the size of this task, sometimes it can be overwhelming. But as many people say, Korea is a very dynamic country. People like to see things change. So I think I can rely on that to strengthen my optimism.